Hello and a warm welcome to Portfolio Watch with myself, Victor Mupunga. Now today we're looking at the importance of holding defensive shares in your portfolio. Usually when markets are going up, we tend to neglect defensive shares and sectors in favor of more cyclical trends that are influenced by macroeconomic dynamics. Each, though, do play a different role in your portfolio. And a number of reasons have led to a divergence in performance between cyclical stocks and defensive ones, ranging from macroeconomic factors to investor psychology and sector-specific reasons. To tell us more about these details today and perhaps some stocks to consider in our portfolios, I'm joined by my guests in studio, Victor Mupunga, Research Analyst at Old Mutual Wealth, Private Client Securities, and Rowan Williams, Director at Nitrogen Fund Managers. Gentlemen, a pleasure to have you both with us this evening, and thanks for making time. Let's actually start off with getting an understanding of defensive stocks and the defensive sectors. Which exactly are they here?
Well, I suppose the way to simply think about it is defensive stocks are those stocks where consumers have to buy their product, often repeatedly. I suppose the case in point would be alcohol, which is often given as an example to say customers tend to buy the alcohol during difficult times, and they tend to buy the alcohols during good times as well. So that's one product that or service that would certainly fall within that category. Cyclicals, on the other hand, are largely driven by sort of a faster growing economy. When the economy is growing well, there are certain products or services that consumers tend to consume a lot more of. These tend to be products or services that are highly discretionary in nature, and when the economy slows down, consumers buy less of it. I'd say that's sort of a simplistic way of thinking about it.
So back to the basics and quite simplistic, and going back to the fundamentals as to what it entails from a consumer perspective. But Rowan, to get your view on this, what have the trends really been regarding defensive stocks, especially over the last 5 years at least?
Yeah, so actually it's interesting. We've had a period where stock prices generally have performed particularly well. There has been cases where the defensive stocks actually have been quite highly valued. I think what you've seen is we've had very low interest rates globally, and that has put a premium to some extent on growth, but also on yield, so in the form of steady dividend payers. So because that's one way to get access to an income stream much higher than what you would get cash in the bank. So you've seen sort of these, and the point about defensive stocks is they are steady dividend payers. You can be quite reliant on the dividend and the expectation of a dividend. So we have seen the likes of British American Tobacco, Vodacom, actually for periods being quite highly rated because of their higher yields. And that is an attractive element. And you would get that yield regardless of actually the valuation of the company as well, which keeps them attractive and an important part of a portfolio.
Just on that, before we do get into some of the stocks which you've already highlighted on very briefly, what we've often noticed with some of the defensive sectors is that they tend to get disrupted. And that's really become quite a sexy term of late in the business circles. But whether it's regulation or new technologies and innovation that comes on board, or maybe just a slight change in consumer trends and interests, sometimes it does have a slight knock-on effect on the dynamics that we see in these companies and their growth. What are your thoughts on how we need to manage this as investors, given that we also don't want to get caught up in too much of the noise?
Look, I suppose because we are in the midst of a World Cup, a soccer analogy is probably appropriate. While we all enjoy watching the Ronaldos and Messis and
all of whom unfortunately are out now. Absolutely.
I think we'd agree that a team that's sort of made up of 11 Ronaldos is unlikely to do well over the course of an entire tournament. And a well-balanced portfolio is one that has all elements of it. In terms of, you've got your defensive and you have your more exciting. Certainly your more exciting or high growth cyclical stocks are the ones that would disrupt, which brings back to the point to say you need to have a well diversified portfolio, because during the periods when sort of your high growth stocks are the ones that are being disrupted, your defensives that are selling products or services that are not really discretionary in nature because consumers have to buy them, are unlikely to be disrupted as much.
And with that said, very briefly, I also want to get your feel for the dynamics with regard to defensive stocks. Do they always need to be consumer based?
Yeah, look, I think what you've got is consumers continually have to consume. So food-based stocks and certain, I guess, more addictive type stocks, tobacco, for example, mobile telephony.
Pharmaceuticals, maybe?
Yes, are things that people have to consume regardless of the economic environment. So that does make them defensive. I think the important point that you're making is there's still long-term cycles in different sectors. So there may be a decline in tobacco usage, for example, especially you've got millennials and new types of consumers that have different tastes and preferences. So you may think, oh, this is a stock for the long term that I can keep as a cornerstone in my portfolio. Any portfolio analysis, stock analysis, you have to consider long-term trends and how that may be impacting a particular stock and whether it's time to move out of it and rotate to a new player that makes up part of your portfolio.
Well, we've certainly set down the landscape regarding defensive sectors to consider and stocks to consider in our portfolio. But let's get into it now in our equity segment. Time now to get into the equity segment for some stocks to consider including in your portfolio. And the first one is British American Tobacco, which the both of you have actually alluded to. Well respected, well known on the South African JSE All Share Index. Is it one for us to consider? What are the fundamentals here?
Yeah, look, I think if we look globally, not only in our South African market, it's fair to say that tobacco stocks have probably been the most unloved stocks over the last 2 or 3 years in terms of performance. Globally, it's not South African specific reasons only, but you look at British American Tobacco's peers, your Japan Tobacco, your Imperial brands, they've all underperformed significantly. And our feeling and our sense is that a lot of that has to do with the next generation products that tobacco companies have invested significantly in over the last few years. So initial testing seemed to suggest that that was going to do very well. Forecasts were saying they were going to make up a third, I think, of total tobacco sales in the next 12 years or so. But more recently, that has slowed significantly. It seems as though people are not moving to sort of your e-cigarettes and your vaping products as much as they were expected to previously. Now keep in mind, this is happening in an environment where the actual volumes of traditional cigarettes have been declining significantly at 3–4% per year. The number of people in the world who are smoking in terms of percentages has declined significantly. Sin taxes continue to increase, we know they do every year, competing with illicit cigarettes. So in that environment, sort of your next generation products are very important, and their success and regulators regarding them as scientifically less risky compared to your traditional cigarettes is very important. So I think that explains why British American Tobacco has underperformed. But having said all of that, this is, as you mentioned, a very well-known defensive company that consumers continue to buy a lot of their products. They're trading at a valuation that is probably as cheap as it has been for the better part of a decade. And in terms of operationally, they recently moved into the US a lot more than they were exposed to in the past with the Reynolds acquisition. The US, I think, now makes the largest contributor to their group's profits, and that's a very profitable market because affordability is not an issue in the US as far as cigarettes are concerned. They also have significant exposure to emerging markets, which if you're going to get any growth within traditional cigarettes, that's probably where you're going to get it. So I think on the balance of probabilities, the market has probably taken into account a lot of the risks that are in British American Tobacco at the moment.
So things clearly looking up for British American Tobacco. You want to add to that,
Yeah,
Rowan?
I think the important point that Victor's making there, the entry point can be quite important, and the British American Tobacco in particular has underperformed recently, so it is looking much more attractive on valuation grounds. And I think defensive stocks at the right price actually can perform very well. You get the dividend yield. As I mentioned, actually as the price comes down, the implied dividend yield goes up that you're entering at. And then I guess you've got this margin of safety, and they do have this continuous demand for their product. So it's an interesting one because there are cyclical changes. So I think the point is the entry point becomes more important where there are cyclical changes in terms of long-term performance of the underlying business.
Let's talk about our next stock, and maybe some of the themes that you've also alluded to there might apply to Vodacom too, given that it's enjoyed again a sustainable revenue streams for quite a number of years, seeing that shift away from voice more to data, but of course also trying to adapt in a world that is also changing due to legislation, due to consumer pressure. And of course, as shareholders, we're still looking for that sustainable dividend. What's your take on Vodacom and the sustainability of the stock?
Yeah, so some people have said that mobile phones are the new cigarettes. cigarettes, I mean, that people are really addicted to their phones, use of their phones, and what we have seen is a huge growth in data, and really the growth of the smartphone and the prevalence of it and the ease of use and the access to data and information, I think really is a long-term mega trend. Clearly there are, again, regulatory pressures in terms of pricing, particularly on data, which has been the very profitable and growth segment for these mobile operators. So that creates, I guess, some pressure. But these are very defensive businesses. I think you don't leave home without your mobile phone anymore. And the youth of today, that's their primary method of communication, of interacting, socializing. So it has, I think, long-term sort of stickiness. It's just a question of, I think, some of the impediments in South Africa. We've seen access to spectrum, which has been of concern, but I think that will be addressed. And there are still a lot of secular growth prospects in Africa, which is driving continued sort of attractiveness. So this has long-term potential. Again, I guess valuation is an issue, but certainly a dependable dividend yield and should be dependable growth.
Just on that, how does it compare to its competitors as well? MTN being one of the top ones up there.
Look, I think one thing that does stand out about Vodacom when you look at their South African market, which as Rowan alluded to, is the largest contributor to their profits, is that a lot of their clients in South Africa are actually the post-paid market, or the contract customers, we sometimes refer to them. And those tend to be a lot less price sensitive compared to your prepaid users. So I think that adds to that defensiveness. And then Rowan also touched on the African operations in terms of the opportunity that they have there. While there are peers like MTN, I mean, we know that they've been burnt in Nigeria, and now there are challenges as well in Iran with the new sanctions that are being imposed in that market. Whereas Vodacom, on the other hand, a lot of the markets in which they operate in South Africa, you don't have as much political risks, which I think speaks to the defensive quality of the business. We know recently they concluded the Safaricom acquisition, and by doing that they got exposure to M-Pesa, which is arguably the best sort of mobile money operator in Africa, if not in the world. And if they're able to execute on M-Pesa the way they've done in Kenya, in the rest of the African markets, I think that's a significant growth driver for them.
So strong fundamentals for that particular company as compared to many of its competitors in the market. Do stay with us. We'll come back with more stocks after the break, the likes of AVI, Medtronic, as well as Raynet. Stay with us. There's more after the break. And we're back here on Portfolio Watch, where our topic is focusing on the importance of holding defensive stocks in your portfolio. Joining me in studio are still my guests, Victor Mupunga, who's a research analyst at Old Mutual Wealth Private Client Securities, and Rowan Williams, director at Nitrogen Fund Managers. Now, earlier on, we did touch on some key stocks for you to consider, British American Tobacco and Vodacom in particular, but we have Medtronic that also features here. Victor, tell us more about this one.
Yeah, look, I think when people think defensive, healthcare is certainly one that comes to the top of the list. And you know, when we think globally, even over the last few years, you know, one wouldn't think that they've been defensive because, generally speaking, it's a sector that has underperformed. A lot of the reasons we think have to do with sort of the sector as a whole, regulation. I mean, we've touched on regulation earlier on, but I think if there's one sector where regulation has been and is probably going to continue being the key risk, it's certainly within healthcare, and that's because the broader population is exposed to this sector, and so governments and any other person or entity that has any concern with the broader population, they would focus on the sector. So with Medtronic, I mean, the way we think about it is that if regulation is going to be one of your key risks, you want exposure to a stock that is globally diversified, and Medtronic certainly gives us that. You know, they operate in over 150 countries. The US is the largest contributor to their revenue, generating I think about 60% or so of the revenue, and then you have a considerable portion coming from emerging markets and other developed markets as well. If we look at the products in which they produce or manufacture and sell, they were actually the first company to sell cardiac pacemakers back in the 1950s. And since then, sort of devices related to the heart have been a key area of innovation and growth for them, and those devices contribute about 1/3 of the group's revenue. And then you also have a segment that they refer to as minimally invasive devices. Now, if you look across, or rather in surgery, you'll see that one of the key trends that you see there is that doctors, or surgeons rather, are moving away from big incisions, cutting people up, and rather making smaller incisions and putting in devices and carrying out the operations looking at a screen.
So that fourth industrial revolution in technology is certainly shaking up that space too.
Absolutely, and that contributes 1/4 of their profits. So again, that speaks to long-term growth trends that you're seeing in aging population, people needing more healthcare, and a well-diversified business. And in Medtronic, we get exposure to that.
That does speak to a global company though, but coming back to South African fundamentals, we can't ignore the recent news flow regarding the NHI and of course the recent changes to the medical aid schemes. Is that something that we need to be more cognizant of if you have the likes of Life Healthcare and Mediclinic in your portfolio as a South African investor? Rowan?
Yeah, I think Victor has made a good point that the healthcare sector, in particular the service providers, so those are the large hospital groups, they will see ongoing and continued regulation, which is really topping and capping their top line. Interesting, we were talking to a service provider into the healthcare sector, and they're saying the advent of big data has also allowed medical schemes to do more analysis of where the claims are coming from, what is the makeup of what they're paying for, and pick up things like over-servicing more easily. And so I think there again, the fourth industrial revolution, technology is changing the way people can look at the outcomes from healthcare service providers, and I think possibly just better manage how money is spent. And I think that will be a long-term, again, impediment on growth on the healthcare service providers. So Medtronic, I think, is a much more defensive play to play the healthcare sector generally.
On to another stock that we're keeping our eye on today, and AVI. Usually I think biscuits and some cosmetics, and clearly they've got a strong client in me because there's some sustainability there.
Yeah. I mean, you're spot on, Google. I mean, if you look at, or if you think of AVI, a lot of the products that they sell, you think of your Five Roses, your Fresh Pack on the biscuit side, your Bakers, your Provitas. Those are all brands that are either number 1 or number 2 in the segments in which they operate. Apart from just being number 1 and number 2, if you think of their absolute market share, and I'm thinking Fresh Pack is an example in Rooibos. They have a market share in excess of 50%. So almost when you think Rooibos, you're thinking Fresh Pack. And I think that kind of entrenchment in the mind of the consumer, that's what you want as a brand, because the moment consumers walk into a store, they're going to get your product. And I think what probably speaks to AVI's business quality and defensive nature is the way they've been able to put through price increases over the last few years, despite the fact that volumes have been coming off. By and large, they've been able to do that, and I think that is true testament to a quality business in that they're able to pass through prices, have revenue growing even in a difficult market, and I think that certainly is a very defensive company.
We can't ignore that it has competitors. Tiger Brands is a lot larger, so Pioneer Foods.
Exactly, so I think that's a very good, and what is the difference between them? Because some of the food groups are much more cyclical, and that's partly also driven by input prices. So if you look at something like Tiger Brands, and even more so Pioneer Foods, they are more involved in commodity foodstuffs, the likes of maize and bread, where you've got input costs in the form of maize, for maize meal, and then wheat for bread. And those we have seen, particularly because of changing weather patterns, significant cyclicality in pricing, and that has been quite challenging for them to manage at a margin level. Where I think AVI has got a much broader base of less commoditized products, so less competitive, a stronger brand position, and they've been very good. Management have to be applauded at how they've been able to manage the margin in these moving environments, and I think it certainly stands out of those three as the best stock to pick.
We've also got 2 more to touch on, and Rainet is also one of those that features on our list. Sometimes a slightly distant relationship with customers here, but what's your take on it, Rowan?
Yeah, so I think really this is a derivative of British American Tobacco that we spoke about earlier. Rainet is a holding company set up by the Rupert family, of which its principal asset has been and still remains British American Tobacco. But it does have a portfolio of other assets, the most important of which is a business called Pensions Corp, which is a UK-based business which is buying actually pension liabilities from large UK companies. Again, this is quite a mega trend where the defined benefit schemes the companies no longer want to manage that liability, so it's being bought out by this Pens Corp, and that has grown to become close to 20% of the NAV of Reinet. So if you're buying Reinet, you're getting a lot of British American tobacco, which we've said is a defensive stock, and then this Pens Corp, which we believe is also quite a defensive business in terms of managing people's pensions on an ongoing basis, so which is also a long-term trend. So it's more balanced. It also trades at a discount to the sum of the parts, so it's up to a 40% discount, which is quite attractive in terms of defensiveness and margin of safety, which is again something that we look for.
Mm-hmm. Do you want to add to that one, Victor?
No, I think as long as you have that large contribution from British American Tobacco, that will certainly act as a very attractive point in accessing British American Tobacco. I did mention earlier on that it's trading at valuations that you haven't seen in a long time, so Reinet would certainly be looking even more attractive from a valuation perspective.
Mm-hmm. What about another company that we often think of, but of course given its restructuring over the last few years has certainly taken on a very different role in society, and that's Altron?
Yeah, so I mean, this is interesting because it was a business that has gone through various cycles and is somewhat of a reincarnation, I guess, with the Fenter family largely moving on from a management perspective, and new management coming in, and also new partners, value capital partners. So I think what you've got now is a fairly diversified technology business, and they're focusing more on technology. They've got rid of the cyclical businesses, which were the manufacturing businesses involved in mainly power transformers and to a lesser extent cables. And now you've got more service-related businesses into the ICT sector, and there they're taking advantage of this move to broadband. So they have a lot of operations that are providing the underlying infrastructure for broadband systems, and then the other large part of the business is also partly UK based, where they're providing Microsoft licenses and renewals of Microsoft licenses. So again, something like that, the stickiness of Microsoft is something that we see as quite defensive. So I think they've repurposed and refashioned the business to become a lot more defensive and reliable and less cyclical, and that's why we like it.
Yeah, there are several themes that you both have highlighted as we've explored many of the equities to consider for our portfolios, and of course valuation has been one of them. How, as an investor, do I need to analyze and make sure that I'm asking the right questions when it comes to my money manager, getting into a stock at the right time, especially to make sure that it's a good dividend payer and that defensiveness is actually maintained within that particular stock, given the levels of volatility that we've alluded to today? Yeah.
Look, I think the way one could look at it is, it doesn't necessarily hold that a sector or a stock that has done very well over the more recent past and is probably expensive will continue doing well going forward. Yeah. I think one needs to move away from that type of thinking that, technology did well last year, so I'm just going to continue buying into technology. I think one needs to look at it from a balanced portfolio perspective. In doing so, you will certainly get some of the bargains that are in the market at the moment.
Mm-hmm.
I think for private investors, there's quite a simple piece of analysis that actually comes out of a book called The Little Book That Still Beats the Markets. It's actually two factors, two filters that you can apply. The one is return on capital employed. So look at the company, how it is deploying its capital and earning money off the back of that capital. Mm-hmm. And then the second one is earnings yield, which is actually the inverse of your PE. So you're basically looking at the PE ratio. The lower the PE ratio, the higher the earnings yield, which is what you're looking for. And then so you're looking for low PE stocks with high return on capital. And I guess an example is British American Tobacco. Because the P's come down so much, the earnings yield is up there. They're still delivering very good return on capital. Yeah. It's looking attractive at these levels. And you can look at that and sort, and you'll find possibly some diamonds that are worthwhile in the long term.
Indeed. And of course, maybe that capital allocation also gives us some insight into the broader long-term strategy in order to make sure that these businesses are sustainable in future. Absolutely. Gentlemen, a great pleasure having you both with me in studio today and giving us some insight into stocks for us to consider when it comes to defensive sectors to make sure that you see that capital appreciation in your portfolio. A big thank you to both my guests for joining me today. Victor Mupunga, Research Analyst at Old Mutual Wealth Private Client Securities, and Rowan Williams, Director at Nitrogen Fund Managers. Do join us again next week here for more on Portfolio Watch, and also feel free to share your thoughts with us on social media. From myself and the team, have a good evening.